Hello, my name is Kalgin, and I'm a tax partner at a firm called KEPT, which is former KPMG Russia. And I decided to record this video to share my experience about tax planning in international structures. I specialize in cross-border structures and help my clients to improve the tax efficiency of their international businesses. My team and we help clients to do restructuring projects and to make sure that their investment structures are tax compliant, efficient, and are in line with the most recent tax trends. This is what I do, and I decided to share my experience and provide examples of situations where tax efficiency of international structures can be improved, so how to improve the tax efficiency of investment structures. We specifically work with companies who have assets in Russia and in the CIS region, as well as presence or operations in other countries such as Cyprus, the United Arab Emirates, Switzerland, the Netherlands, Hong Kong, Singapore, and other countries that are typically used in international tax planning. Okay, so in this video, we are going to talk about tax planning solutions, and I will provide specifically 12 examples how tax planning can be, or tax efficiency can be achieved in international structures. But we will start, part one of this video will be about what a typical international business structure looks like. And it's important that the content of the video is supposed to be, it should be easy to understand by the people who are not necessarily tax experts, but who participate in making decisions that affect international structures and their tax efficiency. For example, lawyers, finance people, business owners, etc. This is the idea. This is why we are going to start by looking at a typical international business structure and typical flows that can occur and typical transactions between companies in a business structure. Second part will be about principles of international tax planning, which I'm going to explain based on practical examples. We'll have 12 examples. One set of examples or cases will be about tax planning on profits, how to make sure that profits in a business structure are not excessively taxed and are distributed to the shareholders of the business in a tax-efficient manner. The second set of examples will be about tax efficiency of financing structures. We'll consider 3 examples there. Third part of examples, 2 cases will be about tax planning in structures so that restructuring projects are carried out in a way that they do not create excessive tax burden in future, or how potential exit from a business should be considered upfront, and in view of potential exit from a business, tax structuring decisions are made. And finally, there will be 4 examples of tax efficiency, how tax efficiency can be achieved in operating structures. This is the main part of the video. And finally, we'll conclude by drawing some conclusions from what we discussed, from the examples that we'll consider. Okay, this is the plan. And first of all, the first part, what typical international structure looks like. On these slides, let's look at a business owner who establishes a company to conduct business. And this company employs people and, has certain assets to perform whatever manufacturing or trading activities. The company pays to its suppliers and receives money from its clients. This is the most basic sort of one-cell structure of a business, where already we see transactions and cash flows between different entities. But as time goes by and this business grows, it becomes more complex. there may be more shareholders. Well, other shareholders may join the business, and the shareholders decided to establish a holding company, as is shown on the slides, to manage the business and to settle relations between the shareholders, how they run this business. And the holding company is a separate legal entity that owns subsidiaries or operating companies. And for example, there is a property company that's invested money to build or acquire, let's say, a plant or a factory. The holding company financed this acquisition or construction. So the property company, its main purpose is to hold assets, and it also should pay interest on the loan to the holding company, that on the money, on its debt to the holding company. But the main activities, the production itself, takes place in the operating company that employs people, and it should lease the property owned by the property company, to make sure that it is able to conduct its operations. And when goods are manufactured, they're supplied to a separate legal entity, the trading company. And already in this structure, we can see that there are at least 4 legal entities, and there are transactions, cash flows between them. And each of these transactions, has tax consequences, and obviously this is where tax planning starts, and it's important to make sure that there are no tax leakages in these various transactions. Another example, what a typical IT company or IT business may look like. Again, shareholders established a holding company, and this holding company owns subsidiaries that are different from the manufacturing business that we looked at before. There is an R&D company that employs people, let's say software engineers, who develop software. And there is an IP company that finances the development of software and then becomes the owner of the end results of the developed software. And then there is a distributor, or there are distributors in various countries that license the IP developed by the R&D company and owned by the IP company, and they provide licenses or products based on the developed intellectual property, the developed software. Again, here we can see different transactions, cash flows between the companies, and they all have tax consequences, and there are tax efficiency considerations to be looked at. Yeah, the holding company also may employ the managers, the top management of this business, which obviously means that the holding company incurs costs which should be financed, and it is not uncommon to see management fees charged to the operating companies by a company, in this case, by the holding company that employs managers, and that kind of is a cost center to serve the whole group. Again, another example of transactions and cash flows in a complex business structure. Basically, these transactions or cash flows, they can be divided into 4 categories. The first one relates to current profits and their distribution to shareholders of a business. That's one type of transactions. Yeah. Second type of transactions relates to financing. There is intra-group debt, loans, interest payments between different legal entities. Okay, these types of transactions, they relate to financing. Third, there are transactions, they occur, from time to time, related to exit from individual projects or from the business as a whole. And finally, there are intergroup operating flows, and this is the most diverse and differentiated parts of the 4 categories, where one can see very, very different transactions that relate to operating the business, in general, well, making sure that business operates as a, as a whole. Let's look at, before we consider specific examples, let's look at how these transactions or how these types of cash flows can appear in a given business structure. Again, a holding company on these slides with its operating subsidiaries, and for example, the operating subsidiary 1 can generate profits which can then be distributed as dividends, and the shareholders may decide that these dividends should be distributed to the shareholders. This is why in this structure where we see two layers of companies, there is a holding company and its operating subsidiaries. It's necessary to declare dividends at each level, and the dividends are first distributed to the holding company, which then declares and distributes dividends to the shareholders. Another scenario is where these profits that are generated in one part of the business by the operating company 1, they may need to be reinvested into other projects that require financing. And here is an example where the holding company that received dividends from the operating subsidiary reinvests, contributes these profits, for example, into capital, or provides a loan to the operating company that requires financing, that requires investment, for example, to purchase an asset or to build a plant. So these are examples of current profits and their distribution to shareholders. This is type of cash flows that illustrates how this can be, how this can occur in a given business structure. Second group of transactions: financing, intra-group debts, loans, and interest. Again, as in the previous example, the operating company generated profits, and instead of declaring dividends and distributing them to the holding company, it may directly provide loans to the companies that require financing, for example, the operating company 2, or the holding company can act as an intermediary in intra-group financing, in which case, as is shown on the slides, the operating company first provides loans to the holding company, which then in turn lends these funds to the operating company 3. Okay, this is the part of intra-group debts or parts of transactions that relates to financing. Exit from individual projects and a business as a whole. Again, for example, the operating company 1 in the structure that we are considering may finish its project and may need to be liquidated because just its project is now over. In which case, liquidation proceeds are distributed. Whatever is left from the business that the company ceased to conduct is distributed to the holding company, which can then use these assets to invest in, either to sell or to invest into other projects. And this is an example how exit from a particular project can be achieved. Another example, a sale of whole division, like an operating company, a whole operating company can be made if a decision is taken to divest from a particular division, as is shown on the slides. The sale takes place. A sale takes place where the holding company disposes of its investments in operating company 3. And finally, some or even all shareholders may decide to sell the business in general, and they dispose of their investments in the holding company. All these examples, they kind of illustrate types of transactions or cash flows that relate to exit from specific projects or a business as a whole. Okay, and finally, operating cash flows and operating transactions. Again, between different operating companies, there may be supply chain flows, supply chain transactions, and the management services may be provided by the holding company. These are all examples of of operating transactions, operating flows. Okay, and we are going to build our video, this discussion around these 4 categories of transactions, categories of cash flows, and we'll consider each of them because they all have different. There are different solutions that can be used to achieve tax efficiency in different types of cash flows in different situations. Okay, so what needs to be remembered? What takeaways can be made from the discussion about typical business structures, typical international businesses, and how they are usually set up. First of all, modern international businesses are complex, and there are multiple legal entities and intra-group transactions, contracts, cash flows between them. And each transaction, cash flow, contract has tax consequences which need to be managed. This is the idea of overall tax planning in a complex business structure. Let's now move on to specific examples and case studies. And the first 3 cases will be about tax burden on current profits and its distribution to shareholders of a business. Example 1, functional companies. Or what are functional companies? Functional companies can be used in a given business to make sure that, well, it's structured properly, and they can also be used to achieve certain tax advantages or to reduce tax burden in a particular situation or business structure. Examples of functional companies include trading companies, R&D and intellectual property companies, management companies. So typical examples, specific legal entities set up for specific purposes. These are functional companies. Let's look at a trading company. As on this slide, there is an operating company that, well, it can mine coal or whatever, produce goods that are then needed to be supplied to the customers of this business. But a trading company is used as an intermediary, and it concludes contracts with customers and purchases whatever was produced from the operating company. So it is not uncommon to see trading companies in business structures, and these trading companies employ personnel. They are responsible for sales, logistics, can perform similar functions like marketing. So yeah, this is the purpose of usual functions. These are usual functions of a trading company. Yeah, and as I said, in this example, and generally, the trading company purchases produced goods and supplies them to end customers. And here, the trading company usually does generate certain profits that can be allocated to, based on arm's length principles to its activities. And these profits, depending on the location and the tax regime that this trading company relies upon, can be taxed at lower rates. And overall, it's not uncommon to establish trading companies in countries where either the tax rate is low or there are special tax regimes available for trading companies. Again, historically, Switzerland was known as a location for establishing trading companies. There is no so-called mixed company regime anymore in Switzerland, but still, trading companies are seen there, especially given that in many cantons of the Swiss Federation, local cantonal tax rates are low. Singapore is a country where trading regimes are available for trading companies. This is why, again, it's a common destination, especially when supplies are made to customers in Asia and the Asia and Pacific region. Cyprus, given its low general corporate income tax rate, is a common and popular location for establishing trading companies. And Hong Kong, especially given that there is a so-called offshore regime, or, well, yeah, territorial tax regime in Hong Kong that allows in certain cases not to tax even active income altogether, is a popular destination as well. And I see in my projects instances, structures where trading companies are set up in Hong Kong. And the United Arab Emirates is another possibility, is another country. It used to be, the country was well known for its absence of any profit tax or any tax at all. But recently there was a tax reform in the country, but still trading companies, if they fulfill certain conditions, they can qualify as so-called qualifying residents of free trade zones, and they can use 0% corporate tax rates, which again provides certain tax advantage or gives a possibility to reduce the overall tax burden on trading flows, trading activities. And this is why the UAE is a popular destination for trading companies. Next, another type of functional companies are used in, other types of functional companies are used in intellectual property businesses like software or IT businesses. And yeah, R&D companies and IP companies are not uncommon in such businesses. And as is shown on this slide, in this example, there is an R&D company that performs R&D activities, research and development, that develops IP, which is financed by the IP company, which then commercializes this IP and sells whatever customers can buy and are needed to end customers, and it owns the intellectual property. So here we can see two functional companies, the R&D company and the IP company. Yeah, okay, so the IP company, its function is to finance their research and development and to own the end results. The R&D company, it usually employs people and performs the research and development activities. These two types of companies, it's not uncommon to see them in countries that provide favorable tax regimes, provide favorable tax rates for R&D and for R&D activities and for IP ownership. Typical examples, almost in every EU country, it is possible to achieve, especially in relation to R&D activities, given that the activities, I don't know, for example, software development is localized and is performed specifically in the country, but other jurisdictions are popular and possible as well. Again, examples include Singapore, Hong Kong, and even in countries such as Russia and Kazakhstan, there are special regimes or special locations where it is possible to establish a company and to enjoy even corporate income tax rate exemption specifically for development activities, for IT development activities. Okay, so and finally, another example is of a functional company is a management company. Management companies are typically set up in complex businesses where it is necessary to employ highly qualified personnel that then provide services to various operating companies. So yeah, as is on this slide, there is a management company that employs a global management team and provides inter-group services, for example, consulting, strategic management, and outsourcing of certain functions to the operating companies. And again, the United Arab Emirates are not uncommon to be seen to be used as location for managements, for companies' managements, and management companies are not uncommonly set up in the United Arab Emirates. Okay, it is necessary to remember that functional companies, they should be used properly and certain risks should be avoided. For example, empty companies in the current environments usually do not address tax risks. They often lead to tax risks. So like an empty company is hardly able to pretend to properly generate profits. Indeed, arm's length principles and current transfer pricing rules, they dictate that companies without significant people functions, they hardly able to, in intra-group transactions, they are hardly able to pretend to generate significant profits. So time when empty companies were set up to achieve tax advantages, they are now over. They are in the past, so empty companies usually do not address tax risk. They can create risks. This is why a structure with functional companies should be based on specific business needs. And it's important to allocate profits properly within such a structure between functional companies and various other entities in the given business. Okay. Let's consider another example before we move on to the next case, where allocation of profits between entities in a structure can be tax efficient. This example will illustrates why it is important to make sure that profits are allocated properly and also imbalances are avoided. Let's look at a case where there are two companies and one generates profits and the other one is loss-making. So just as an example, company 1 generated profits of 1,000 and company 2 had a loss of 500. And in both countries where this company is allocated, the tax rate is the same, 20%, but only the profitable company pays tax, while the loss-making company obviously doesn't have a tax base. And it can carry over this debt or this loss, but the profitable company, it has to pay 200 in taxes because the tax rate is 20%. And despite the overall profit is 500, 1,000 minus 500, the effective tax rate is 40% because only the profitable company paid 200 in corporate income tax rate, and the effective tax rate is 40% because 200 divided by 500 is 40%. So despite in each country, each company is liable to pay 20% income tax, the effective tax rate is 40%. So this example illustrates that it is important to make sure that there are proper allocation of profits and imbalances, such as is in this example, are avoided. Obviously, situations may occur where such imbalances are unavoidable, and there are transfer pricing considerations where it is impossible to avoid losses in a particular legal entity. But still, it's necessary to remember that in a complex structure where there are multiple legal entities, it is important to avoid situations like this to the extent possible, obviously. What are potential solutions? How these imbalances can be avoided? So first of all, there may be reasons for the loss-making company to incur losses. It may have significant costs, and this may mean that this company either employs people or provides some valuable and important intra-group functions. And making sure that this company receives income from these functions is one potential solution to address this risk. So if this company 2 in the previous example charged 500 to the profitable company, then it would have recognized 500 as an expense, and as a result, its profits would be 500 instead of 1,000, and the tax rates will be 20%, which is normal, which is more appropriate, which is more efficient. It's not always possible, and another solution could be to extend interest-bearing loans from loss-making companies to profitable companies. It may be difficult because the loss-making company may not have funds to provide loans, but interest income on the parts of the loss-making company and interest expense on the parts of the profitable company that borrows funds from the loss-making company is another tool, is another instrument how reallocation of profits between the profitable company to the loss-making company can be achieved. And finally, there are countries where it is possible to transfer losses at least between companies of the same group in this country. Sometimes even cross-border transfer of losses is possible, but in many instances, for example, in Cyprus and the United Kingdom, there is a regime that allows to recognize losses within the group that occurs in one legal entity for the purposes of taxation of income in another entity in the same country. Or sometimes a special tax consolidation regime is available. So, for example, in the Netherlands and in the UAE, it is possible to consolidate companies. It requires specific filing. There are conditions, but overall, tax consolidation is another tool where basically it is not important to it will be not important to make sure or to monitor the allocation of profits between various legal entities, because they are all considered as a single taxpayer, despite there are different legal entities. Okay, so what conclusions can be drawn from this first example, where we considered functional companies as a tool, as a way to mitigate taxes and to plan taxes within a complex group structure? First of all, indeed, functional companies can be used and can structure international activities and manage an effective tax rate by allocating profits from a high tax country to a lower tax country, where a special regime, so just lower regular tax rates, allows to tax profits at a lower rate and reduce the tax burden overall. But to be tax efficient, functional companies should have proper substance and address business needs. They should be in line with business in general. They should have genuine purpose. And finally, the third conclusion is that profits should be allocated properly among legal entities. And this means that, first of all, imbalances should be avoided, but at the same time, artificial shifts of profits from one legal entity to another, which is not in line with transfer pricing principles, is not appropriate either. Okay, let's move on to example 2, where we look at local holding companies as a tool, as a means to plan distribution of profits and to make sure that profits are taxed in an efficient manner in a given structure. So on this slide, you can see that there is a holding company in Hong Kong that owns 2 operating subsidiaries in Russia. Hopefully the subsidiaries are profitable, at least one of them, which then distribute dividends to the holding company, which can be either distributed to the company's shareholders or to reinvested to another operating company, in this example. Well, the point is that dividends are usually taxed at source, and in Russia, dividends withholding tax is 15% based on domestic rules. It can be reduced in some cases to as low as 5%, but still, from many countries, it is not possible to distribute profits as dividends without withholding tax, without paying tax in the country where from which these profits or dividends originate. This is why whenever we decide to reinvest profits from one subsidiary to another, even though the subsidiaries, as in this example, can be in one country, given that there is a holding company outside and given that dividends are subject to withholding tax, it's impossible to redistribute or reinvest profits through the holding company, through a foreign holding company, as in this example in Hong Kong, without paying tax, which is not efficient. This is why, if instead we had another holding company, as in these slides, a sub-holding company which is 100% owned by the holding company in Hong Kong, but this sub-holding company is located in Russia, then it is possible to distribute dividends within one country and from the operating companies in Russia to the Russian sub-holding company free of tax. There is, and as well as yeah, in many countries, and Russia is not an exception, it is possible to distribute dividends between domestic companies without paying taxes. In Russia, there are conditions: 1 year holding periods and 50% participation, but it's easy to fulfill these conditions in a given group structure. So again, establishing a subholding company can help to achieve reduced or even eliminate taxation of profits that are reinvested within a business structure between different operating companies. Yeah. So the conclusion here is simple. Local holding companies can be used to reduce tax costs when profits are reinvested among companies within a given group structure. Next example, reducing tax costs within profits distribution to shareholders. As we remember, shareholders ultimately usually expect their business to generate profits, and they expect dividends to be paid. This is why, and since dividends are subject to taxes in different countries and sometimes on different layers of the structure, it's important to plan structures accordingly in view of future dividend distribution. So, okay, dividends can be taxed at least twice in a given structure, even in the most simple case. They are usually taxed at source, where so-called withholding tax is withheld and remitted to paid as tax to the state, and income that is received either by the shareholders of a given structure or by intermediary holding companies, they can be taxed where these recipients, these shareholders or holding companies, intermediaries are located. So income in form of dividends is subject to tax when it is received twice as a result, at source and upon receipt. So it's important to remember that there are two types of tax benefits that can be relied upon to make sure that there is no excessive tax burden on dividend flows. First is reduced withholding tax rates, and second is participation exemption or credits of withholding tax where in countries or where dividend income is received. So let's look at a specific example. Again, business. There is a business structure here with a holding company and its operating subsidiaries that distribute dividends, and the operating company distributes dividends. The holding company receives them and distributes as dividends to the shareholders. Withholding tax can arise, the withholding tax can arise in countries where the operating companies are located, and this tax can be reduced under double tax treaties between the country, under a double tax treaty between the country where the operating company is located, the specific operating company is located, and the country where the holding company is set up. Next, dividends are taxed in hands of the holding company, but usually holding companies, they are set up and established in countries where participation exemption is applicable, or at least withholding tax can be credited against the local income tax on dividends in the country where the holding company is located. And finally, further distribution of dividends has basically the same tax consequences. Withholding tax at source, now in the country where the holding company is set up, and taxation in the hands of the shareholders. So let's look at a specific example. As on these slides, there is a holding company in Kazakhstan that owns operating subsidiaries in Russia and Kazakhstan, and they distribute dividends. And in Russia, withholding tax, as I said, for dividends is 15%, but it can be reduced to 10% based on the double tax treaty between Russia and Kazakhstan, which is an example of reduced tax rates and tax planning that relies upon double tax treaties. Then, in Kazakhstan, there is no taxation of domestic dividends, so dividends can be distributed from the operating subsidiary in Kazakhstan to its parent company in Kazakhstan. Then dividends, when received in Kazakhstan, they are not subject to tax either. And then distribution from Kazakhstan to shareholders, which are Russian tax residents, again subject to the same 10% withholding tax. And for the shareholders, Russian personal income tax is 13 to 15%. Let's, for simplicity, assume that 15%. They should pay this tax, the shareholders, but the withholding tax, which was paid in Kazakhstan, can be credited against this personal income tax liability. This is why the ultimate additional payments, additional tax liability for the shareholders in Russia will be 5%, 15% less 10%. Okay, let's make a calculation and see what tax burden we have in this particular structure, and then compare it to different other scenarios and options for holding companies. So let's start by looking at the Russian parts of this business. And profits after tax in Russia, let's assume 100. Then 10% withholding tax rates in Russia reduces payments of dividends by 10%, by 10 units. Then, as we remember, the holding company in Kazakhstan receives dividends and the tax rate is 0. There is no tax leakage here. Then withholding tax on further payments of dividends from Kazakhstan to the Russian shareholders is 10%. It applies to the remaining profit of 90, which means that there is 9 units liability on withholding tax or 9 units withholding tax liability in Kazakhstan. Then personal income tax in Russia is 15%, again applied to the declared dividends of 90, which means that the actual tax payments, actual tax liability is 13.5 units. And there is a possibility to credit the withholding tax paid in Kazakhstan of 9% against the Russian tax liability. So if we sum up the taxes paid at each level of this dividend distribution chain, we will end up with a total tax burden of 23.5 units. Okay, let's remember this result. This relates to the Russian parts of the business, of the holding structure. Before we move on to the Kazakhstan part of the structure, let's also remember that in Russia it is possible to apply a so-called look-through approach to dividends, and the Russian subsidiary may claim that it pays dividends for tax purposes directly to the shareholders, although legally it will be still distribution through all the layers through the holding company. But the end result, we will not go into details of this calculation, but the end result will be the same. The total tax burden in this case is going to be 23.5 units, and it's important to remember that this look-through approach only applies to Russian taxes, only Russian tax liability of the Russian shareholders and the Russian operating subsidiary. It doesn't affect how dividends are taxed in Kazakhstan, for example. Before we move on to the Kazakhstan parts of the business, let's remember that there is a so-called look-through approach in Russia that provides an alternative tax treatment of dividends, and the Russian subsidiary that declares dividends for tax purposes, it can claim that the dividends are attributable to the shareholders and taxed accordingly in Russia, as if they were distributed directly to the Russian shareholders. Although legally, from legal perspective, the distribution will be through the chain of ownership, through the holding company Kazakhstan in this example. But we're not going to look into details of this calculation, but the result is the same. So this is the point. It doesn't improve in this particular case the tax efficiency of dividends flow. But it's important to remember that there is such a possibility, and in some cases it can improve it can reduce the tax costs. Okay, so now the second part of the business, Kazakhstan. Again, let's assume that profits in Kazakhstan after tax are 100, and these profits are distributed to the holding company. There is no withholding and income tax in Kazakhstan relating to domestic dividends. This is why 0 units are paid at this level, at the level of the holding company. But when the holding company distributes dividends, the same 10% withholding tax applies based on the Russia-Kazakhstan double tax treaty. And again, the same personal income tax applies, the same personal income tax liability arises for the shareholders who are Russian tax residents. But again, the same withholding tax credit can be achieved, or the withholding tax credit can be used, and the tax burden overall, given all credits and liabilities, is 15 units. Okay, let's remember this result. On this table, there are different layers of taxation in the structure with the Russian and Kazakhstan subsidiaries are summarized as we just discussed them. And it's interesting to compare what tax costs will be, what tax costs would arise if another holding company, another location for the holding company is used. Hong Kong, for example. Unfortunately, Hong Kong is blacklisted in Kazakhstan. This is why the Kazakhstan part of the distribution results in a higher tax burden of 32 units as compared to 15 units when a Kazakhstan company is used. But in Russia, it is possible to achieve a reduced withholding tax burden because first of all, there is a double tax treaty between Russia and Hong Kong, and in this particular example, we do not even have to apply it. The important factor that stands behind the reduced withholding tax and reduced tax burden on these dividends that originate from Russia is just simply because Hong Kong, if structured properly, would not tax dividends neither at source nor when dividends are received from Russia, in this example, and from Kazakhstan as well. So unfortunately, there are pros and cons of using a Hong Kong company, and in Russia we will see an improvement. In Kazakhstan, the tax burden will increase. But in some other cases, and again, the balance should be achieved between different countries. And yeah, another important consideration is that we need to make sure that tax-free benefits apply, which is another complication and another task for structuring, especially holding companies. And two more examples: Singapore and a Singapore holding company and an UAE holding company. Again, as shown on the slide, the Russian part basically remains the same. It is possible to achieve the 15% overall tax burden on dividends through channeled through holding companies in these two countries. And again, the reason is that we just do not pay additional taxes at the level of these holding companies in these countries, if again structured properly. With Kazakhstan, the result is more or less the same. There are double tax treaties between Kazakhstan and Singapore and between Kazakhstan and the United Arab Emirates. But it's important to remember that although technically 5% withholding tax rates are achievable in Kazakhstan, it may be difficult to use them, and there are mechanisms or there are procedures that imply that first withholding tax should be paid by the operating company in Kazakhstan, and then it can be refunded. And this is the way how double tax treaties or reduced withholding tax rates are achieved in Kazakhstan in such structures. And it's difficult to get a refunds for tax withheld on dividends, as in this case. But still, for the calculation, we assume that the refund is achieved and the tax burden is, well, comparably low, at least compared to a holding company in Hong Kong. So this is an example how calculations can be made to make sure that we choose the location of the holding company properly. 4 conclusions that can be drawn from this this discussion. Before we move on, just to mention that there is a so-called look-through approach that can be used by the Russian parts of the structure, where technically what happens is that the Russian subsidiary declares dividends and for tax purposes treats them as if they were distributed and paid to the shareholders, to the ultimate shareholders, in this case in Russia as well. And the tax treatment in some cases, this tax treatment can help to achieve reduced withholding tax burden, but this calculation, which will not go into detail, but this calculation demonstrates that the result will be basically the same. The same 23.5 units will be paid on the Russian profits that are distributed through the holding company in Kazakhstan to the shareholders using the so-called look-through approach, which is only used for tax purposes because from legal perspective, these dividends are going to be declared to the same holding company, and they will go through the intermediate holding company as is supposed in normal circumstances. Let's now look at the other parts, at the Kazakhstan parts of the structure, where profits after tax in Kazakhstan, let's assume them to be the same 100 units. Again, as I said, there is no taxation of domestic dividends in Kazakhstan. This is why we are not going to lose taxes between the operating subsidiary in Kazakhstan and the holding company, which is also in Kazakhstan. But then, when the holding company distributes dividends to the shareholders, the same 10% withholding tax applies, and 10 units should be paid as withholding tax in Kazakhstan. And then the shareholders ultimately receive income, dividends. Their tax liability, Russian personal income tax liability, is 15%. This is why 15 units of tax is accrued, but there is a possibility to credit the Kazakh withholding tax against the Russian personal income tax. This is why their returns, this credit is positive. It reduces the tax burden. And overall, 15 units of tax are paid all through the chain of ownership and dividend distribution from Kazakhstan through the holding company in Kazakhstan to the Russian shareholders, which is better than the Russian part, but okay, still, it is what it is. And let's now compare different options. Again, on this diagram, on this table, taxation of dividends on several levels is reproduced. We see the same numbers here for the holding company that is located in Kazakhstan. But if we assume that the holding company was in Hong Kong, in this case, the Russian parts, again, using this look-through approach, the Russian taxation of dividends can be reduced to 15%. And this is mainly due to less tax burden or absence of taxation of dividends in Hong Kong, because if it's done properly, then dividends should neither be subject to withholding tax in Hong Kong, nor should be subject to corporate income tax in Hong Kong. So there is no tax leakage if done properly in Hong Kong, but in Russia, ultimately, the overall tax burden is 15%, which is the minimum withholding, which is the tax which is ultimately paid by the Russian shareholders. Unfortunately, Hong Kong is blacklisted in Kazakhstan. This is why there is going to be increased withholding tax when dividends are paid by the subsidiary in Kazakhstan to the holding company in Hong Kong. And then, shareholders are also going to pay 15% on what remains, on what is paid out of Kazakh profits through the Hong Kong company to the shareholders, and the total tax burden is 32 units, which is not as good as 15 units if we used if we used Kazakhstan to set up the holding company for the business. And two more examples with holding companies in Singapore and the United Arab Emirates. Again, Russia is consistently applies the Russian parts of the Russian taxation of dividends is consistent. In both cases, it's 15%. Again, we see the improvements compared to the holding company in Kazakhstan, because again, there is no tax leakage in these two countries, Singapore and the United Arab Emirates. If used properly, holding companies there should not pay taxes on dividends received, and dividends distributed to the shareholders. But in Kazakhstan, there is a double tax treaty. There are double tax treaties between Kazakhstan and each of these countries. This is why potentially withholding tax rate can be reduced on dividends to 5%. It is highlighted on the table because it doesn't apply automatically. The way it works in Kazakhstan to these countries is that, first of all, dividends should be paid and tax should be withheld at source at the full rate, and then the tax treaty benefits apply through a refunds mechanism. This is why 15% is then 10% of the 15% withholding tax are then claims from the state, but it's difficult, not always, doesn't always happen, the refunds. This is why it needs to be taken into consideration. But if all goes well, then the 5% rate applies, and in both cases with the UAE and Singapore, the total burden on the Kazakh parts of profits is going to be 19.3 units. Okay, so calculations like this, they are useful when structure is either set up or modified so that we choose the right location for the holding company, and we make sure that we do not lose taxes on future dividend distributions, which will hopefully take place if the business generates profits. Okay, what conclusions can be drawn from this example where we looked at structuring of dividend distribution and making sure that there are no leakages on distribution of profits to the shareholders of a business. First of all, it's important to remember about the taxation of dividends and to take this into account when developing an international structure or changing it. Second, withholding taxes and taxation of dividends upon receipts are two main mechanisms how dividends are taxed, and they should be taken into account. There are incentives. There are reduced withholding tax rates based on double tax treaties or domestic exemptions or domestic rules. And there are participation exemptions, so-called participation exemption rules, where dividends can be exempt, especially holding companies. They are located in countries where participation exemption rules are favorable. But if for some reason participation exemption or full exemption of dividends does not apply, then withholding tax credit can be applied to avoid excessive tax burden. It's credit of tax withheld at source on a particular distribution of dividends. And finally, what can be changed? Usually, allocation of the holding company can be changed, and sometimes the shareholders, they may, in a given business, they may move from one country to another and change their tax residency. And it's not uncommon for business owner to consider tax rules and consider tax regimes in different countries to make sure that their income from their businesses is not excessively taxed or even fully exempt. Okay, let's now move on to the next part where we look at tax efficiency of financing structures, and we'll consider three examples of how financing structures can be made and how the tax efficiency of financing structures can be achieved and maintained. The first example will be about deduction of interest, and it will be important to remember that in a given structure where there are financing flows, interest payments, it is important to remember that dividend interest deduction should be achieved. This is what it looks like usually. Let's consider a structure where there is a holding company, in this case, just for a change, located in Hong Kong, and there is an operating company in Russia, another operating company, but let's focus on Hong Kong and Russia for the time being. Let's assume that there is a loan that the holding company provided to the operating company, and obviously this means that interest is accrued and then paid, hopefully, if there is a source for payment of interest by the operating company, it's paid from Russia to Hong Kong. Well, first of all, let's think a bit and compare or consider what the holding company could have done instead of extending loan. An alternative usually is providing capital, and there are two basic mechanisms of financing operating activities. One is providing loans, and the other one is contributing money into equity. And the question arises: what is better? How to choose? What's more tax efficient? And let's just look at a comparative example or comparative calculation of tax efficiency. If loan is provided, then interest is paid. If equity contribution is made, then whatever operating profits are generated, they are then distributed as dividends. Basically, the way or the amount of payments is not dependent on the way we finance the company. This is why in this example we just compare apples to apples, and 100 of interest and 100 of dividends. So the operating company is able to pay either dividends or interest depending on the way it was financed, and the amounts are 100 in both cases. If interest is paid, the main advantage is that interest is usually deductible. This is okay. This should be taken care of, and there are limits and rules which we are going to talk about in a minute. But overall, if done properly, it is possible to deduct interest. While dividends, they are paid from after-tax profits. This is why there is no additional tax saving or tax effect that's achieved in connection with dividends as compared to interest, where we achieve deductibility and some positive tax effects. In this table, the interest deduction is taken into account and accounted for by just reflecting 20 units of deduction based on the tax rates in the country where the operating company is located. For dividends, there is no deduction. This is why tax deductibility effect is zero. Then there is withholding tax, and again, in Russia, dividends are taxed at source. With Hong Kong, there is double tax treaty and 5% withholding tax rate, which again needs to be achieved, and there are conditions to be met to apply the reduced withholding tax rate. But overall, it is possible to reduce withholding tax on dividends from 15% to 5%. And for interest, there is an exemption in the double tax treaty. This is why interest can be paid from Russia to the Hong Kong holding company free of withholding tax, which is another advantage in this particular situation of interest compared to dividends. Then let's imagine that in Hong Kong, for some reason, interest is taxed because, well, it was structured in a way that it falls under taxation rules, while dividends, they are exempt. Let's just imagine that this is the case, and still the overall tax effects is in favor of interest, although interest should have been and should be taxed in Hong Kong in this example. This is why the total balance, the total tax effects of dividends compared to interest is in favor of interest. This is why, if done properly, interest is more beneficial, and loan financing is preferred. And for that matter, many countries established rules that limit deductibility of interest, because the tax authorities understand that in intra-group financing, for intra-group financing purposes, the business can choose, and obviously more efficient means of financing are usually chosen. This is why it's important to avoid excessive tax savings, so to say, based on the preferred way of financing. Well, in this case, loan financing. So if we on this diagram, on this chart, if we have an interest rate reflected on the vertical axis of on the vertical axis and the loan amounts on the horizontal axis, then the multiplication of interest rate at the loan amount gives the total interest, which is the rectangle, the violet rectangle on this slide. But interest rate for deductibility purposes is limited to an arm's length level, while there are so-called thin capitalization rules that usually limits the amounts of loan that can be taken into account for deductibility purposes, for intra-deductibility calculation. This is how thin capitalization rules work in Russia. And as a result, as is shown on this slide, the deductible interest is only part of the overall interest that is accrued, and some parts of the accrued interest is non-deductible. This is important when we structure loan financing, and the key point here is that tax leakages or tax efficiency can be achieved. Tax leakages can be avoided if we take into consideration deductibility limits for interest and make sure that the interest level is at arm's length, and we observe the thin capitalization rules that also limit the amounts of interest that can be deducted. Achieving a full interest deduction is important. Key consideration, as I said, arm's length interest rate and thin capitalization limits, and tax efficiency can even be negative if interest is subject to tax but is not deductible. In our example, if it was taxed in Hong Kong but wasn't deducted in Russia, then we achieve a sort of reverse result. It's anti-tax planning, where we do not deduct but have to tax income. Next example, tax arbitrage in a financing structure. Again, let's look at a specific example and specific structure where there is an operating company in Russia and an operating company in Uzbekistan, again, just for a change, which pay interest to the holding company, which previously provided loans to its subsidiaries. What happens is that it is possible to achieve interest deduction, and since in Russia income tax rate, corporate income tax rate is 20%, and the tax effect is 20% of interest paid to the holding company. In Uzbekistan, the tax rate is 15%. Again, this means that the deduction results in 15% of tax savings. 15% of interest is deducted. 15% of interest is the tax effect of interest deduction is 15% of interest amount. And for example, if the holding company was in the United Arab Emirates, then there is no. First of all, withholding taxes should be considered, and interest is subject to withholding tax. In Russia, it's 20%, and unfortunately, there is no double tax treaty between Russia and the UAE, while there is a treaty between the UAE and Uzbekistan, but the withholding tax rate is the same as the domestic tax rate in Uzbekistan. This is why we are going to lose in Uzbekistan 10% of interest payment, and in Russia 20% of interest payment. We can assume that if done properly, it is possible to avoid, or it is possible to apply 0% corporate income tax rates in the UAE to interest payments. This is why there is no additional tax burden, tax leakage here. But overall, we achieve some, as can be seen, we achieve some positive tax effects in Uzbekistan because we save 15% of income, 50% of interest payments, and only have to pay 10% and only lose 10% as withholding tax. In Russia, there is more or less balance between the tax effect of interest deduction and the withholding tax liability. Another example, if we look at Hong Kong as the holding company location, with Russia, we can achieve a benefit of exempting this income interest income from withholding tax. So we reduce tax leakage here from 20% with which we had with the UAE, but yeah, to 10% to 0% here with Hong Kong. Between Uzbekistan and Hong Kong, again, there is double tax treaty, but no, I'm not even sure. Anyway, there will be 10% withholding tax rates on payments from Uzbekistan to Hong Kong, because in Uzbekistan, basically interest withholding tax in the domestic law is the same as in most double tax treaties. Yeah, okay. And finally, in Hong Kong, this interest is going to be taxed, or let's assume that in this case it's going to be taxed, and then the withholding tax in Uzbekistan can be credited, hopefully, against Hong Kong corporate income tax liability. And what we end up with is that we save on the Russian part of interest payments, because we save 20% instead of, and lose only 16.5% of the interest amount. And in Uzbekistan, it's more or less even, because the saving in Uzbekistan of 15% is comparable, almost the same as the interest taxation in Hong Kong of the regular, of the usual, the basic corporate tax rates of 16.5%. Yeah, so, and finally, an example of interest payments from Uzbekistan and Russia to Kazakhstan. Again, withholding tax of 10%, 20% corporate income tax in Kazakhstan, and a possibility to credit the tax withheld again in Kazakhstan against the withholding tax, against the local corporate income tax liability. The end result doesn't seem to improve the structure if we compare it, for example, with a holding company in Hong Kong. There, the basic tax rate, the general tax rate is lower. This is why, this is why this structure is less tax efficient in relation to interest payments, especially in relation to interest that is paid from Uzbekistan, where the tax rate is lower than the interest, where the tax rate is lower than the tax rates in Kazakhstan that applies to this same income. Okay, and it is especially counterproductive and inefficient to provide loans to companies that cannot deduct interest. And this example perfectly illustrates this. Let's assume that there is a holding company in Cyprus that owns an operating subsidiary in Russia and an operating subsidiary in Uzbekistan. And for some reason, these operating companies, they provided loans. The holding company needed financing, and these operating companies provided loans to the holding company, which means that interest should be paid back from the holding company to the operating companies, and they tax this income and lose 15% of this interest income. If they are profitable, they should include this income into their profits and pay 20% of tax in Russia and 15% of tax in Uzbekistan. While Cyprus is not likely to be able to deduct this interest, because it's not uncommon for holding companies not to receive any taxable income. Dividends are exempt in Cyprus. Other income may not even be there. In which case, interest payments that are made of that are financed by dividend distributions, they are just not deductible. And this is, so to say, this is anti-tax planning or anti-tax arbitrage, which definitely should be avoided. This is an example where a structure is inefficient, and yeah, the conclusion here, it's not favorable. It's not favorable to provide loans to companies that are not able to deduct interest, while the companies lending the money should pay tax on interest income. So yeah, the conclusion is in a financing structure, a positive net tax effect is achieved when the tax rates in the borrower's country is higher than in the lender's country. So this needs to be taken into account. Next example, we will look at creating financing or changing financing structures in course of restructuring projects. Let's look at this structure where we have a holding company with 2 operating subsidiaries and a shareholder that owns the holding company and also owns another operating subsidiary. And there is an intention to bring this operating company into the business owned by the holding company, and this can, for example, be achieved by selling this operating company 3 to the holding company. So the shareholder may decide to sell the operating company that he or she owns directly to the holding company. In this way, a restructuring is achieved so that the holding company owns its operating subsidiaries. In which case, it's going to be the holding company will have a debt to the shareholder for the sale of the operating company, for the acquisition of the operating company from the shareholder. Is it a good thing or bad thing? First of all, this can be beneficial, creating such a debt, if, for example, the sale of assets is not subject to income tax, or the taxation of income tax from the sale of this operating company by the shareholder is deferred, which is the case in Russia, for example, where income is taxed when it's actually paid. It's included into personal income tax base when income is received. This is why if debt remains, then the sale is not taxable. Obviously, when the debt is settled, then a tax liability arises, but it may be deferred. Or in some countries, income from such sale is not taxable altogether. And by the way, in Russia, there is so-called 5-year exemption that can be relied upon, and there will be no income tax liability altogether if the holding period is long enough. So this is why selling assets can be beneficial, but it's also possible to achieve tax arbitrage. So even if this income can be taxable, in this case in the hands of the shareholder, the tax rate is lower, and compared to 20% tax rates that applies at a corporate level, 15% personal income tax is definitely lower. So in course of restructuring, some tax arbitrage and resulting financing structure can be used to achieve positive tax effects. Let's now look at how financing structures can be changed. And on these slides, this is an example where there is a holding company and an operating subsidiary. There is a shareholder that owns the holding company, and the shareholder, sometime in the past, extended a loan to the operating company. But we need to interpose the holding company into the financing chain, and this can be done by two ways. First of all, the shareholder may assign his or her rights to this debt, to the loan, to the operating company, to the holding company. In which case, there will be the financing structure will change, as is shown on the slides, and there will be a debt between the holding company and the shareholder for the acquisition or for the sale or for the assignment of the loan, and there will be now a loan between the holding company and the operating company, because the right to claim the initial loan was transferred to the holding company. So we effectively interposed another entity, in this case the holding company, in the financing chain. It may be necessary in course of the restructuring, for example, or some other considerations. It can be done differently, and instead of assigning the receivable by the shareholder, the operating company's debts can be transferred to the holding company. And the end structure, the resulting structure, economically will be the same. Legal-wise, it's a bit different because now the operating company will have debts under the loan transfer or debt transfer agreements to the holding company, while the holding company will be the new debtor of to the shareholder under the initial loan agreements. But the end structure is the same. And it is also possible to eliminate an intermediary, excludes a company from a debt chain. For example, if we ended up with a structure where the holding company is an intermediary between the operating company and the shareholder, then it can settle its liability to the shareholder using the asset, the initially extended loan, so that now the holding company is no longer liable to repay its debt to the shareholder because it repaid it using its receivable, and the claim is back to the shareholder, which is now the creditor of the operating company under the loan agreements, under the debts of the operating company. Okay, two conclusions here. First of all, sometimes during a restructuring project, it makes sense to create intercompany debt, which can then be used when structuring cash flows in the future. And it is always possible to exclude or add intermediate entity in the chain of intra-group debts, which may be necessary importance in course of restructuring projects. Okay, and by the way, both changes or both things, creating debts and changing the debt structure can be made in a tax efficient manner, and even some tax benefits can be achieved along the way. We have now finished considering financing structures, and we should move on to examples that relate to structuring in view of potential exit from business, exit from a business, and structuring that is aimed at reducing tax costs upon exiting from a business. Let's look at an example where we structure business in a way that is tax efficient when exit from the business is made. Again, simple structure with a holding company, its shareholders, and a few operating subsidiaries. And it is possible to divest from a particular division by selling an operating company as a sale of an operating company shown on this slide. Also, shareholders may decide to sell the whole business and exit from it altogether. These are the examples of potential transactions. What should be taken into account? First of all, it's not uncommon to see countries and instances, situations where capital gains are tax exempt. For example, I already mentioned the 5-year exemption in Russia. It applies to sale of subsidiaries, shares, and so-called participatory interest in limited liability companies. The main condition is that the shares interests are held for at least 5 years. It applies to individuals and legal entities because the more or less similar conditions, rules exist for personal income tax purposes and for corporate income tax purposes. Then there is a so-called 3-year exemption in Kazakhstan. There are limits to it. It doesn't apply to companies that conduct subsoil, that have natural resources and subsoil licenses, for example. But still, in many instances, after a 3-year holding period, a subsidiary in Kazakhstan can be sold without taxation of capital gains. there are unconditional capital gains exemption rules in Cyprus, and specific exemption rules exist in many countries. For example, in most EU states, as well as countries such as the UAE, Hong Kong, Singapore, etc. That's one thing. Capital gains are often exempt. It is possible to convert capital gains into dividends in some cases, and for that reason, holding companies can be used, as we will show in this example. So, if shareholders decided to exit from the business, then they can sell their shares, as on these slides, on this example, their shares in the holding company. But instead, if the operating companies are disposed of, then the holding company receives capital gains. The capital gains may potentially be exempt, in which case the shareholders receive dividend income. And dividend income can be subject to lower tax rates, or can be exempt, while capital gains may not be exempt for one reason or another. For example, in Portugal, so-called NHR rules, they exempt dividends in many instances, but in many cases they do not exempt capital gains. This is why this sort of conversion of capital gains into dividends makes sense. And there are other examples like this. The third factor to be taken into account is that restructuring shortly before a specific transaction takes place creates tax risks. So, for example, such restructurings can be requalified as if no restructuring took place, and tax consequences are recharacterized in a way that is unfavorable, to ignore the results of the restructuring, which was assumingly aimed at achieving tax advantage or just not taxing in. This is why not taxing income from exit of business, exit from a business. This is why a tax efficient structure should be set up well in advance before significant transactions that may happen in the future, such as exit from the business. Conclusion. When creating and changing the structure of a business, it's important to take into account the future tax burden when exiting individual projects as well as the business as a whole. Next example, maintaining and enhancing tax costs during restructuring. Let's look at a structure where there is a holding company 1 and a holding company 2. And the first holding company, as is shown on this slide, owns an operating company 3 in this diagram, and the holding company 2 needs to acquire this company because the idea is to bring it to the business of the holding company 2, which happens to be in Russia. The holding company 2 is in Russia. There are, from legal perspective, there are 2 ways to contribute, to contribute the operating company 3 to holding company 2. One would be contribution to property, so-called contribution to property or to assets, and the other one is more or less commonly used contribution to equity or into nominal or like paid-in capital. There are differences. In Russia, when contribution into property is made, it is unfortunately leads to loss of cost basis of the assets which were contributed to property. So in this case, if holding company 1 made significant investments and incurred significant costs in relation to operating company 3, then after contribution to property of holding company 2 of this operating company 3, these historical acquisition costs or historical investments are going to be lost. The holding company 2 is not going to be able to deduct anything when it disposes of or liquidates the operating company transferred to it as a contribution into property. This is why when contributions into Russian companies are made using significant assets with significant cost basis, it's more beneficial from tax perspective to make contributions into equity. In Kazakhstan, if holding company 2 was in Kazakhstan, and this is the second example, then contribution into equity is also a preferred mechanism because not only because unlike in Russia, although unlike in Russia, contribution into property doesn't lead to losing the cost basis of the asset, but unfortunately, such contributions, they are not tax neutral. There is no specific exemption, unlike in Russian tax law. There is no specific exemption for contributions of property into assets in Kazakhstan. This is why contribution into equity are preferable. And moreover, when contribution is made into equity, into nominal capital, it is possible to use the valuation made upon the contribution for future tax purposes, which provides certain tax benefit and even can lead to tax advantage when contribution is made. Because again, the cost basis is not only maintained, but it also increased if the valuation is higher than the historical costs. Another example. It is possible to increase tax costs during a restructuring, and here on this slide there is a structure with a Russian shareholder which owns a holding company with 2 operating subsidiaries, and the shareholder owns directly another operating company 3, which needs to be transferred to the holding company. And if it is sold, then again, it is possible to establish the price higher, well, based on the market value of operating company 3, and that provides effectively a step up and in cost basis for the operating company that is transferred to the holding company. And either the 5-year exemption can be used if the holding period is long enough, or the tax events for the shareholder can be deferred if payments is deferred for the sold operating company. If instead of a sale we decide to contribute the operating company to the holding company, it's important to remember about so-called material gains and rules that tax issuance of shares in exchange for assets for individual income tax purposes. And in this case, if contribution is made into capital with issuance of additional shares of a Russian company or any company, doesn't really matter. But if additional shares are issued, then accumulated capital gains and increased market value of the operating company which is being contributed is going to be subject to personal income tax based on these so-called material gain rules in Russia. This is why when contributing assets into subsidiaries of Russian tax resident individuals, it may make sense to avoid issuing of additional shares, in which case again a contribution into property can be preferred. And although in this case, as we remember, the tax basis is lost, unfortunately, but still there is no immediate tax effect for the shareholder, which is a proper, which may make sense, and it may be preferable to make this sacrifice of future tax basis in case, well, the contributed operating company is disposed of by the holding company, but at least at the moment or when the contribution is made, we avoid the tax cost for the shareholder. Okay, 3 conclusions. First of all, when making restructuring, it's important not to forget about the tax cost basis, which we do not want to lose. Second, sometimes it's even possible to increase the cost basis during restructuring, again, depends on particular circumstances. But there are instances where it is better to avoid tax costs by sacrificing the future cost basis, as we discussed in the last example, where contribution can lead to income tax, personal income tax liability for the shareholder if additional shares are issued upon the contribution. Okay, the final part of the presentation is related to examples about operating structures, and we will look at 4 cases where tax efficiency of an operating structure, where tax efficiency of an operating structure is either improved or at least tax costs are avoided. The first example relates to VAT costs during intra-group transactions. So let's look at a structure where there is a holding company in Cyprus that owns subsidiaries, and specifically there is a management company. Let's for example consider a management company in the United Arab Emirates. This management company employs personnel and it charges management services to the holding company. In which case, in many countries, there are so-called reverse charge VAT rules, and Cyprus is an example where if services are acquired by a Cypriot company from a foreign, well, non-domestic, non-Cypriot service provider, then the holding company in this case should charge so-called reverse charge VAT and accrue VAT on receipts of management services, in this example. Unfortunately, if the holding company does not have output VAT, then this reverse charge VAT is lost effectively. It can't be deducted against any output VAT, and this creates an additional tax burden for the whole structure. The VAT rates in Cyprus is 19%, so effectively it creates additional almost 20% on management costs in the structure, which obviously should be considered and to the extent possible avoided. And it's not only a case with holding companies. Finance companies may suffer from reverse charge VAT that is non-deductible as well. So what to do? There are several solutions that can be considered. First of all, the management can be transferred from the management company to the holding company, in which case there is no going to be service charge. Management fees are not going to be charged at all. The holding company will incur these costs directly, and the reverse charge VAT disappears, and the management company is no longer necessary. In which case, we get rid of the VAT inefficiency. Although it's not always possible to move the group's managements from one country to another. There may be personal preferences and business needs in different countries, but at least this solution can be considered. Second idea: instead of moving the management to the holding company and employing them in a different country, the holding company may establish a branch in the country where the management is located. In this case, in the United Arab Emirates. In which case, there is not going to be service fee are not going to be charged by the management company, because again there is no management company, and branch is a part of the holding company, is part of the same legal entity. And again, this is another way how the reverse charge costs leakage can be avoided. And finally, instead of charging the management services to management fees to the holding company, the invoices, the management services can be charged directly to the operating companies, which may have output VAT because they conduct operating activities. And this, although reverse charge rules may apply in the countries where the operating companies are located. In this case, the advantage is achieved through deducting this or crediting or offsetting this reverse charge VAT instead of losing it as it was the case with the holding company. Okay, so there are solutions. Reverse charge VAT is not lost here. And the same results can be achieved if the holding company charged the management services that it received from the management company to the operating companies. Because in this case, the holding company will be able to demonstrate output VAT or at least transactions subject to VAT, and again, not to lose the possibility to credit or deduct the input VAT charged as under the reverse charge mechanism. Two conclusions from this example. It's not uncommon to see VAT losses in intergroup structures, for example, when service fees are paid by holding and financial companies. But VAT cost can be reduced by transferring service functions to these companies themselves, or by moving the management or creating a branch in the country where the management is located, or charging the expenses to operating companies, either directly or through the holding or the finance company, as the case may be. Okay, next example, withholding tax planning during intergroup transactions. Let's look at a simple structure where there is a holding company that owns two operating subsidiaries, and there is a payment from one operating subsidiary to the other, for example, royalties or payment for services. And it's important that sometimes in some countries such payments may be subject to withholding tax. It can be withholding tax can be applied in the country where the operating company that pays income to another operating company where it is located. So first of all, three factors needs to be taken into account. First of all, tax is most commonly withheld from passive types of income, dividends, interest, and royalties. Second, there are double tax treaties between different countries that can be used to either reduce or even completely eliminate this withholding tax. And on the recipient side, there can be credits or other, the withholding tax that was withheld in the country of operating company one can be credited if withholding tax is unavoidable. So it's important to take this into account. Let's look at some country examples. For example, in the United Arab Emirates, there is no withholding tax at all. In Cyprus, withholding tax started to apply to certain passive payments, but only to blacklisted countries. So in most cases, withholding tax does not apply in Cyprus. But blacklisted countries, they should be they should be taken care of, because, for example, payments from Cyprus to Russia in form of dividends, in the form of dividends, interest, or royalties, passive types of income, is going to be subject to withholding tax because Russia is blacklisted by the European Union. Third, the Netherlands. There is withholding tax on dividends as well as passive payments to blacklisted countries. In Russia, withholding tax applies to passive income, but also services to related services provided by related parties started to be subject to withholding tax this year, 2024. In Kazakhstan, withholding tax again applies to passive payments as well as services, and specifically higher tax rate applies on payments to so-called blacklisted countries, for example, to offshore states such as British Virgin Islands or Hong Kong. Many offshore states are blacklisted in Kazakhstan. Okay, two conclusions from this example where we looked at withholding tax on intra-group transactions, intercompany transactions. First of all, withholding tax often arises in intra-group payments, especially in relation to passive income. And second, tax losses can be reduced if reduced withholding tax rates are applied, or exemptions or tax credits are used. Next example, supply chain tax planning. Let's look at specific structure. Here we can see a holding company and at the same time an IP company. So this company combines holding and intellectual property activities. Let's assume that it's in Hong Kong, and as a holding company, it owns subsidiaries in Russia, Hong Kong, and Kazakhstan. And the subsidiaries in Russia and Kazakhstan are operating companies. They, let's say, they sell goods that they acquire from the trading company or the procurement company that is located in Hong Kong. So the supply chain looks like this. The trading company or the procurement company acquires goods from the markets and then supplies them to the operating companies. This is how it is shown. This is what is shown on the diagram on the slides. Let's look at two possibilities. First of all, the IP company needs to receive royalties for its, let's say, trademark and brand name. So royalties should be charged. And we have two options. Either the operating companies pay royalties or the trading company pays royalties and includes the royalties into the price of goods that are supplied to the operating companies. So in the first scenario, where royalties are paid by the operating companies, there are going to be withholding tax in Russia and Kazakhstan, and also there is a risk that royalties deductibility will be challenged. But at the same time, there is an advantage of not including royalties into the price or into the cost of the imported goods, because customs duties, they are based in many cases on the cost on the transaction price. In which case, if it's increased, then the customs duties increase as well. The other scenario would be to pay royalties by the trading company, in which case the acquisition, the cost of goods are going to be increased for the operating companies, but they do not have to pay royalties and face non-deductibility risks and withholding tax in Russia and Kazakhstan, respectively. But the cost of this is that the price for the operating company that is used as a basis for customs duties increases, in which case the customs duties they become higher. And the conclusion here is that it's usually it makes sense to compare different operating companies and different. It makes sense to compare financial models for two operating structures and see what is better. Either paying increased increased customs duties, or to pay withholding tax on royalties and face the non-deductibility risk for royalties. While if we pay increased customs duties and avoid paying royalties by the operating companies, then non-deductibility risk is more or less non-existent, or it's much lower, because acquisition cost for goods is not usually challenged. Okay, as I said, it's worth modeling the scenarios and compare them. And the last example, management costs and tax planning around it. Management costs and tax planning around them. Again, structure with a holding company, operating companies, and the management company. The management company employs personnel and charges management services to the operating companies. There are three factors, tax considerations that need to be taken care of or taken into account. First of all, it's usually it's easier to deduct local expenses compared to inter-group service fees. So, for example, if it is possible to employ management by the operating companies, it's usually much easier to deduct their salary when compared to management fees that are charged by the management company that employs the management and have to compensate the costs of employment. So if there is a choice to employ locally or to employ in a management company, then local employment potentially, most likely, or in many instances, provides a tax advantage, at least in terms of deductibility or non-deductibility risks. Second factor, it is usually preferable to charge management fees, because if they are not charged, then the group as a whole loses the possibility to deduct them, and they have to be financed through other means, for example, through dividend distribution to the holding company. This is why, preferable to charge intra-group costs and try to achieve the deduction. And sometimes it is even beneficial to give up the deduction, but still finance management costs, because otherwise dividends that are after tax and after withholding tax are just more expensive in terms of tax burden. Dividend distribution used to finance the management costs. And the third factor is it is necessary to provide grounds and justification for deductibility of intra-group management costs. So it is necessary to employ efforts and to spend time to justify the deduction. And it's still not uncommon to have certain risks even after all means, all requirements are met to justify the deduction. So the outcome, the takeaway here is that it's important not to lose deductions for management expenses arising in business structure. Okay, so we looked at 12 examples of how the tax efficiency of a business structure can be achieved, increased, or maintained. Let's now summarize the conclusions that can be drawn from our discussion. First set of conclusions relates to taxation of current profits and their distribution to the shareholders of a business. And we discussed 3 ways to achieve tax efficiency there. First is employing functional companies. Second, using local holding companies. And third, overall planning of a structure in a way that allows to avoid extra costs when dividends are distributed to the structures, to the business shareholders. Second set of conclusions relates to financing structures. And here, the first takeaway is to ensure full interest deductibility. Second, it is important to rely on tax arbitrage on intra-group financing. And third, creating and eliminating intra-group debt in group restructuring can be useful and even can be tax beneficial from tax perspective. The third set of conclusions relates to exit from business. And first of all, the business should be structured in a way that takes into consideration a potential sale. And second, tax costs should be maintained and it can even be enhanced during may even be enhanced during restructuring. And the final set of conclusions relates to operating structures. And here, first of all, VAT losses and costs in intra-group transactions should be excluded. Reverse charge VAT, we discussed how to avoid losing the possibility to deduct reverse charge VAT by in instances where holding or financing company pays third party or intra-group services. Second, withholding tax on intra-group cash flows should be properly planned. Third, the supply chain should be tax efficient. And fourth, management cost deduction is necessary if we are to achieve tax efficiency of financing management costs. Okay. this is all I wanted to tell and share in this video. Again, I'm never tired of saying that each situation is unique and each structure is unique. This is why I encourage you to get in contact with me, and you can find my contact details on these slides, and I will be happy to talk to you about your specific structure and how its tax efficiency can be improved. So thank you for watching this video, and let's keep in touch. I'll be looking forward to you. Looking forward to talking about your specific circumstances or situation and tax planning in this respect. Thank you and have a good day.